Although Bitcoin has risen roughly 60% in 2023, VC funding remains sluggish. Recent PitchBook data shows crypto companies worldwide raised $5 billion in the first half of the year, down almost 75% from a year ago. Joining us now to discuss is the managing partner for VC firm CoinFund, David Pakman. Welcome to the show, David.
Hi, Jen. Thank you for having me. Good to see you. Hey, Lawrence.
Hi.
Let's talk about the recent fund you raised, $158 million back a few months ago. Was it tough to raise this fund given what we're seeing in the broader market and given this data that's come out of PitchBook?
CoinFund's one of the oldest crypto native investing firms around. We've been at it since 2015, and the fund you're talking about is our fourth seed fund. So we've been blessed with a strong group of LPs who've supported us for a long time, and we've been able to add some more. We have a seed strategy, we have a early stage venture strategy, and we have a liquid strategy. So three different products. It's not a surprise to see sort of boom and bust cycles in crypto. It's very similar to the ones we see in tech. We're in our maybe third bust cycle in crypto, bear market, and we've been through all three of those as a firm. I've been through two in the traditional venture world as well. And VC funding tends to be a lagging indicator about what's happening. Venture investing sort of moves in packs. But the constant we've seen among a small group of crypto native investors is that we tend to invest through both boom and bust cycles. We're long-term investors. Seed and venture investing is a very long-term discipline. The average holding period for an investment in funds like that is 8 years. So companies will move through multiple cycles, multiple bull and bear markets. And what we're looking for are companies that build a long amount of enterprise value over a longer period of time. So when the bear markets come, the tourist money tends to leave, the late stage money tends to leave. That's usually the largest check sizes, hedge funds and growth funds. And what you're left with is a smaller group of core crypto-focused investors, of which we're one, and I think the numbers reflect that.
So you guys are the crypto investors, but who are the LPs putting money into this fund? I mean, how many are doctors and dentists versus institutional?
Because we've been at it for a while, we have a pretty broad mix of institutional investors like fund of funds, foundations, endowments, and pensions. And we also have high net worths and crypto founders and friends of ours. So it's a good mix. We've increased the amount of institutional investment capital since raising the first funds back in 2015, and count some of the world's most experienced venture allocators in our LP base.
What are they looking for with this, with giving you this money here? I mean, obviously it's diversification. Everyone will say, well, we want to diversify. It's only, say, 2% of our total net worth we put into this fund, et cetera. But what are they looking for specifically when they invest with CoinFund for this particular round?
They're hoping that we will continue to back some of the largest and most important companies that will be built in crypto and Web3 over this cycle. Venture investing tends to be a model where the largest successes drive the majority of the upside. And so the mission is to back the most ambitious entrepreneurs who will build long-term, sustainable, almost iconic companies or protocols. We've seen a few of those built so far, and the goal is that's what our LPs are looking for us to do.
But are they looking? Are they saying, look, we want to put money into layer ones, NFT? Like, is there anything specific that they're trying to do, and why?
No, I understand. Thanks for clarifying. LPs tend not to make subsector allocation decisions. They pay us to do that. The reason they're investing in experienced managers are because we tend to have more experience picking the subsectors of crypto or Web3 that are likely to produce these sort of outsized winners. Now, our view is that crypto is broad in its innovation set and that we will see giant outcomes in many different layers of the stack, certainly in the base layers like layer ones and layer twos. And a bunch of infrastructure tech that goes on top of that. Like one company we're investors in is Blockdaemon, basically an outsourced infrastructure and node as a service operator. We also expect to see winners in the NFT space, in DeFi protocols, certainly at the application layer, maybe even in wallets and other financial infrastructure. Stable coins today represent probably the most demonstrated killer use case for crypto, with even in this market, $125 billion of stablecoin adoption. So I think there'll be big winners there. But really, our LPs are looking for us to make.
You're not just buying stable coins to be sure. You're not just putting all their money in stable coins, because I got news for you. The returns on that, the capital, the capital appreciation is not going. Yeah, okay.
Are you saying funds are flowing out of like the NFT, the more Web3 focused projects, and into the more infrastructure play?
I would say that a good way to judge sort of where we are in the cycle is looking at where new investments and new entrepreneurial activity is happening. And the majority of that, you get this at developer conferences and you see it in the seed and early venture stage funding, is happening in infrastructure. And that's the base and layer 2 and ZK rollups happening at the core infrastructure layers of crypto. We're seeing a significant amount of activity at the intersection of AI and Web3. We see, as I mentioned, a bunch of activity around new stablecoins and stablecoin infrastructure, and now even some activity around moving real world assets onto chain. So that would tell me that since we're seeing that heavily in sort of the seed and Series A stage, that those are likely to be the companies that move along into the later stage as they make progress. There's also been, at the total top of the stack, lots of activity around gaming. There are more than 1,000 venture-backed Web3 games in the pipeline coming to market, of which at least 400 of them look super promising and exciting. We'll see. Games are a tough market. But many Web 2.5 approaches to bringing gaming on chain, and obviously the NFTs can benefit from that. So I think this is a telltale of where we think things are going.
All right, and this PitchBook data we're talking about says that VC investments in crypto companies have correlated with the markets, but lag roughly 3 to 6 months. So if this trend continues, they are saying that VC investment should rise during the second half of the year. Is this also what you're expecting?
Yes. So I think one of the things that you're pointing out is that all VC tech investing tends to move with the markets as this lagging indicator. We've been in a general risk-off environment for more than a year and a half now. And so you look back at the last several quarters of VC funding broadly, not just in crypto, and we see that decrease in total capital going in. And then as we enter more of a risk-on environment, as interest rates come down, you'll see VC as a full asset class increasing. Crypto is no different from that, with the exception that there are some in the US challenges around regulatory overhang and still, concerns around coming off the FTX debacle and some of the other companies that we've moved past. But the flip side of that is in Europe, where we have much more regulatory clarity, frameworks for launching crypto companies, we see way more entrepreneurial activity in the UK, in Europe, and in a bunch of places in the Far East, Singapore, Hong Kong. So I think you'll see VC investments increase in those regions more quickly than you will in the US in crypto.
All right, David, we are going to have to leave it there. Thanks so much for joining us, and we hope you have a great weekend.
Thanks for having me. You guys too. Thanks, Jen. Thanks, Lawrence.
Thank you.
That was CoinFund Managing Partner David Pakman.